Welcome back to the Roadmap to Retirement podcast. I'm your host, Alex Neary.
Welcome to Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neary, CFP, and guests are here to help you build your roadmap to retirement.
Today, I won't be joined by anybody. It'll be just me, and I want to cover a couple of commonly asked questions or really things that I think a lot of people don't fully understand. And as I'm all about creating financial literacy, so I want to make sure that we address these. The first common question that we get all the time is around credit scores. And I think for myself, I talk to a lot of people who I would consider very intelligent, very successful, well into their adult years, and they still don't really understand how a credit score works. They know that higher is better. They know that when they go to buy things, their score is a factor in whether or not they can get a loan. So I wanted to take a step back and see if I can answer that question for some folks. So your credit score is based on a number of different factors. There's actually 5 different factors that go into determining what your credit score is. And they're not equally weighted, but I'll read them off in order and then we'll talk about what they all mean or what each one means. So first is your payment history. Second is the amount you owe. Third, the length of your credit history. Fourth is the new credit you've applied for, or we call it credit inquiries. And fifth, and finally, the last one, and the smallest factor, is the types of credit used. Starting from the top there, so with payment history, I think that one's kind of obvious, but it's let's make sure that we're making all of our payments on time. I think you hear this from day one when you get your first credit card, but make sure you don't miss a payment because it can hurt your score. So we want to make sure we're making our payments on time, and that will help your score. That accounts for 35% of your ultimate credit score, so it is the biggest and heaviest weighted factor that we have. Second, the amount you owe. So this one also is obvious, but if you owe a lot of money, you have a lot of debt, that's going to be, of course, bad for your credit score. So this one accounts for 30%, so a little bit less than the payment history, but being mindful of how much debt you have. We know this is oftentimes a factor when young people go to apply for something or they want to buy their first house and they've got a lot of student loans or they've got credit card debt or anything like that. Third is the length of your credit history. So this one's a little bit hard to fix later on. So if you're struggling with your credit score and you want to improve it, you really can't go back in time and add it. But it is something to keep in mind when you think about maybe getting rid of a credit card that you've had forever that you never really use, is you may want to hang on to that credit card and keep using it regularly because it might help your credit score if you've had it for 10, 20, 30 years or something like that. It'll definitely help you. Fourth, new credit inquiries. So we've heard this before too, but when a company does a hard pull on your credit, it does hurt your score. So we don't want to abuse the credit system, meaning we shouldn't be always applying for new credit, but it is there for a reason. So don't shy away from never using it, but be mindful if you're always buying things, it might make sense to not always pay for it using credit if you have the cash on hand. And this is only a 10% weight. I don't think I mentioned on the last one, but the length of credit history is a 15% weight. New credit you apply for, credit inquiries are a 10% weight. So significantly smaller than making the payments and the total debt, but still a factor. And finally, the fifth and final factor that goes into your credit score is the type of credit you use. And this one's a little bit confusing. I think a lot of people maybe don't understand it, but you can imagine there's different types of credit. So for example, we have a revolving debt, they call it. This is something like a credit card where hopefully you're charging things to your credit card and you're paying it off each month, but you have this standing line of credit. The max amount you can put on your credit card is maybe $10,000. So you have a $10,000 existing line of credit that you pay off. The other type that's pretty common is maybe a mortgage might be an example of this, but it's your installment. So rather than having an existing line of credit you can spend up to, it's I bought a house and I owe $300,000 to the mortgage company, and I'm going to pay it off in installments over the next 30 years. So they view those as different types of credit. And there's also a third one out there that's a little bit less common, but it's charge card would be a factor where a lot of people don't know it's a charge card and a credit card are actually different. A credit card, you have the opportunity to not pay it off at the end of the month and they'll charge you interest. A charge card requires you to pay it all off in its entirety. And that is that third kind of debt, which is less common. But just understand that different types of debt help you. So we want to have different types of debt out there, and it shows that we're responsible and able to pay it. Why is this so important? I'll ask myself a rhetorical question since I'm talking to myself today. It's mostly important for young folks. It's important for everybody, but a lot of times we see that young people, young professionals getting started in their career don't have a good credit established. So when they go to buy that first house or they want to go buy a car, it's hard for them. So what can we do differently? How can we actually use this knowledge and apply it to our lives to hopefully put ourselves in a better position? If you are a young professional right now, I think recognizing the factors, so paying off the debt, can be a good thing to do. Applying for and using different types of credit helps you. One trick you can use if you were late to the game and you want to apply for credit and you're getting rejected by credit card companies, maybe, or you're going to apply for a mortgage and you're rejected by them too, is you can add yourself to somebody else's credit card. So if you have a parent or a sibling or somebody that cares about you, you can ask them to make you an authorized user on that card. By doing that, you're piggybacking off of their existing credit, and it'll show as if you've had that line of credit for as long as your parent has, and that can help you establish credit that way. I haven't done this myself, but I've seen other people do it, and it can improve your credit score in just a couple months, and that might be enough to allow you to get that mortgage or buy the house that you wanted. Now, if you're later in life, if you made some mistakes in your credit, and that's why you have a poor credit score, it's still very important, and there's some things that you can do there too, whether it's paying off debt, establishing that payment history, which does take time, being mindful of keeping that older credit card open long term. I think that can really help you out. And if you are later in life and you're hearing this and you're saying, I'm good, but I want to help out my adult children or even my teenagers that are coming up, a simple piece of advice is if you got a teenage kid, have them open a credit card. Maybe you have to co-sign for it, maybe you don't, and let them establish that credit early on and make the rule be very strict and say that you're going to pay it off every single month. And if you can't do that, we're taking it away, or however you want to do that as a parent. I'm not here to give you parental advice, but I think that would really help out the credit score. So that's one question we get all the time. I don't think there's anything else I need to really say about the credit score, but those are the factors. I hope that people will understand it. And that being said, I'll move on to our next topic here, which is a simple one, but we get a lot of questions about budgeting and what are the best ways to approach a budget so that you can be successful in it. Because everybody tries to have a budget, everybody tries to follow it, but it's hard. So one piece of advice I think is very helpful, and actually before I get into that, I want to break down sort of some categories here. So let's look at our expenses as the mandatory ones. We're going to say they're fixed, and then we have our discretionary expenses, which are the fun stuff. So if you're somebody that's built a spreadsheet, and I'd recommend that you do this, but build a spreadsheet, put every line item in there for everything you spend money on a monthly or quarterly basis, however you want to do it. And then break it into two categories. So like for myself, I know I have to pay my mortgage. That's not an option. I have a car payment. I have to pay that. That's not an option either. I probably need a grocery shop because if I don't eat, I'm going to die. So let's add that into our fixed expenses. But then let's have another category of things that I'm not going to ask you to stop doing because we want to have some fun in life, but things that realistically we could survive without. It might be going out to dinner. It might be that Netflix account. It might be a million other things that you do for fun, buying drinks, whatever it is. Put those in the other category. So now we can start to recognize what our budget truly looks like. Because I think too many people go through and they say, I spend 10 grand a month and that's what I need. When in reality, maybe their fixed expenses are 5 grand and their fun expenses are another 5 grand, which sounds like a lot of fun. But we can recognize it that way. We can start to piece together what a healthy budget looks like. I think all too often people are on the other side of that too. And they say, I'm spending 10 grand a month and that's way too much. I can't believe I'm spending that much. I'm going to cut it down to 4 grand a month. But again, in the same example, realistically, they can't actually do that. So let's be realistic with our expectations. And then on the fun part, I've seen a lot of people that say, hey, I need to really start saving money. I'm not going to do anything. I'm not going to go out to eat at all. I'm not going to have any fun. I'm canceling Netflix, canceling cable, whatever it is. And I would say that's also not really a healthy relationship with money. We want to, if you're like most people, you go to work every day. You work hard, you earn your money, you want to be able to enjoy it. It's not enough in today's modern world to just pay your bare minimum expenses and survive. We want to thrive, not survive. So build in some money in the budget to have fun. If that means I've got $1,000 a month, that's my fun money. Hopefully that gives you the financial freedom and the peace of mind to go out and spend $1,000 without having any guilt. So that's one approach is the spreadsheet. Let's line item everything in there. That's not great advice because I think it's really hard to follow. I think it's a good exercise to do initially so you can start to recognize where you stand financially and get a grasp on what your budget should look like. But to actually hold someone to that on a monthly basis and be very strict and accountable, I would say 98% of the world is just not going to do that. It doesn't mean they shouldn't do that, but they're not going to do that. So what we can realistically do is my second method here, which is the pay yourself first method. And if you Google this or you talk to any other advisors, it's a pretty common strategy. I did not invent it by any means, but pay yourself first really just means when you get that paycheck, make sure money is going to where it needs to go for savings. So right off the bat, before I even get paid, there's probably something going to a 403B or 401k, whatever it is, my employer sponsored retirement plan. So let's say that I've got 15% of my paycheck going right away into that. And then I earn my paycheck. And before I have a chance to spend it, I want to have money coming directly out of my checking account to fund my Roth IRA. So maybe that's another $500 this month. And I want to have liquid savings as well. I want to build that emergency fund. So maybe I've got another couple $100 that goes towards a separate savings account from what I have existing. And I have an HSA plan, which I forgot to mention. So money's going into that. And hopefully you're maxing out your HSA plan. If you don't believe me, come talk to me and I'll explain to you why you're being stupid if you're not maxing out your HSA plan. So do that. And what I've done is I've created a world where I've got money going to my retirement account. I got money going to the HSA. I got money going to my Roth IRA. I've got money going into a separate savings account that I'm not going to touch to build my emergency fund. And if I've done all of those things and all that happens immediately the second I get paid, now the next day when I wake up, there's less money in my checking account, which is sad, but you're gonna be okay. Now you know that you paid for everything you need to pay for, or you put everything into savings that you need, and the rest of the money there is now your budget. From there, let's subtract out everything else that's in that fixed category we talked about. So when you did your spreadsheet, you had a fixed category of your mortgage payment, your car payment, your student loan payment, whatever it is, and let's address that right away. So now it's 2 days after I've gotten paid. I put everything into savings I need to put in savings. I paid my mortgage, I paid my car, and now whatever's left over is my fund money. And this is the enjoyable part, because now you have X amount of dollars left over. Hopefully it's an amount that sounds good to you. And you know that you can go out and spend that money on whatever you want to spend it on the rest of the month or the rest of the pay period. And you don't need to feel guilty at all because you've already saved for retirement. You've already saved your HSA. You've already saved your Roth IRA. You have money in your savings account. This money is yours. This is the fun money. Go do whatever you want to do with it. And I think that is a more powerful way to build a budget than simply going through the line items and saying, I've got to make sure I don't spend $14 on Netflix this month because I need it for my mortgage. I would rather make sure all those serious things are taken care of so you can go spend whatever you want to spend on all the other fun stuff in life. And trust me, I get it. I like to have fun and I spend some money on, I guess you would say, things that some people would say you shouldn't spend money on. But they're things I enjoy doing. And if it brings you joy, you've got to do it. And that's my kumbaya advice for the day is do things that bring you joy. And the last thing that I want to touch on that's a super commonly asked question is, what is the best way to save for retirement? And we get this from all walks of life. It might be young people starting out. It might be people that are very well into their career or even close to retirement. And they've got the choice. It's an opportunity cost of saving an extra $100 into plan A, plan B, or plan C, or whatever it is. And the reality here is the best way to save for retirement is twofold. One is the thing that you'll actually do. So if you're saying, I'm not going to save my 401k because I'm going to set up a Roth IRA one day and I want to be able to put money into that, but you've been talking about setting that Roth IRA for 5 years, that's not the best way for you to save for retirement. The best way is the way you'll actually do. Now, a level beyond that, it comes down to your specific goals and situation, which sort of is obvious, right? The answer to every question in life is it depends. So for this one, let's just simply say that somebody's looking at either a 401k or some other pre-tax vehicle. So that could be a 401k, 403b, deferred comp plan, 457, whatever it is, pre-tax, or they want to save into a Roth vehicle, which could be a Roth IRA. Oftentimes it is. It could be a Roth 401k, Roth 403b. So they have the choice between the pre-tax, which comes out of your paycheck directly, goes into the account before you pay tax on it. Someday down the road when you retire, you're going to pull it out and you're going to pay tax on the amount you pull out, versus the Roth account, which is after tax. So you've already paid tax on this money today. So way down the road in retirement, when you pull it out, it can come out tax-free, right? Those are the basic differences. And the one that's more advantageous to you has a lot to do with where you are in a tax bracket. And this is why I think tax planning is often overlooked. And it's one of the most important conversations you can have in financial planning. And we're always having it with our clients. But hypothetically, let's say you're a young person, you just graduated college and you got your first job and you're only making, let's call it $50,000. Now, if you're making $50,000 and you subtract off of there the standard deduction, and if you don't know what I'm talking about, reach out and I'll explain it better. But subtract off the standard deduction, now your income is dropping below into the 12% tax bracket. So if you're paying 12% taxes today, I would say for most people, it makes more sense to lean into the Roth. It's okay to pay that 12% tax, let it grow tax-free for decades, and then pull it out and take it out tax-free when you're likely in a higher tax situation. Another example would be somebody on the other end of it. So maybe you're young, maybe you're old, it doesn't matter, and you got a lot more income. Let's say you're making $250,000 a year. For that person, they may not be eligible for a Roth, and we can talk about that in a separate episode, but they're going to be in a much higher tax bracket. So for them, saving into a Roth IRA where they have to pay tax on the money today doesn't make as much sense and isn't as attractive as putting money into their 401k where they're going to get that or they get that pre-tax contribution. So they're bringing down their taxable income. So that person that makes $250,000, they could put more than this, but let's say they put $20,000 into their 401k. Now they're being taxed as if they only made $230,000. That's a huge advantage for that person. So the really simple answer is it depends. If you make a lot of money, you want to go pre-tax. If you make a little money, you want to go after tax. And even if that was all true and simple, there are exceptions to both of those. So let's have a more in-depth conversation about that, or talk to somebody that can guide you through it. On that, I guess I'll quickly mention this. So if you are in a higher tax bracket and you say, hey, I'd still like to contribute to a Roth IRA, but I understand there's an income limit on it. True, there is an income limit. If you're making a lot of money, you probably can't contribute to a Roth IRA in the traditional way. You can, however, do something called a backdoor Roth. So a backdoor Roth works as you make a non-deductible IRA contribution into a traditional IRA, and then you're able to convert it. So it's a Roth conversion, which again is a different topic, but just know it exists. A Roth conversion, so converting it to a Roth IRA. It does the same exact thing as contributing directly to a Roth IRA. It's a loophole that exists in the IRS code. We can talk about why it exists. We can tell you that it's stupid and it should just be a lot simpler, which it is. But the point is, with some good paperwork and someone that knows what they're doing, you can still make a Roth IRA contribution after you get past that income threshold. I think that's what we wanted to cover for today. So we talked about credit score, why that matters, how to improve it, what it's based on. We talked about some simple budgeting tips, which I think that a lot of people could use some help on. And then we talked about how to save for retirement. I think the one other thing I'll throw at you is we talked about how to save for retirement, but let's talk about savings in general. Not every penny you invest needs to be for retirement. I think it makes a ton of sense, and it's a missed opportunity that a lot of people face, is that you could just be saving to an after-tax account, a brokerage account, something where the money's invested for you. It's growing, hopefully at a better rate than inflation and better than you get at a bank. But the money's not tied up or locked up until any particular age. You don't have to wait until you're 59 and a half to draw out of this money. And it could fund a shorter term goal, whether it's buying a cottage in 10 years. Maybe you want to help pay for your kids' college, and there's other ways to do it, but maybe that's the one you choose. Or you just want to have money on hand for a business opportunity comes around if you're a business owner. So I think that makes sense. I think all too many people make the mistake of putting every penny they save into their 401k or even into a Roth IRA. And in doing so, they've locked money up and something comes along or an opportunity comes along and they regret not having access to it. I'll cut it off there. Thank you for listening. This has been the Roadmap to Retirement podcast.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.